Welcome to the Allan Small Financial Show. Thank you for taking the time out of your busy day to spend it with us, as always. This week, wow, what an action-packed week. A lot of economic data coming out of Canada, the United States. We saw the Bank of Canada announce an interest rate increase this morning. We're going to hear from a bunch of U.S. corporations towards the end of the week. JP Morgan, Citigroup, some of the big banks. Delta Airlines, Pepsi will report earnings on Thursday. Big banks will report earnings on Friday. A lot of data to parse through. Where better to parse through that data, or who better to help you get through all that data? Well, the Allan Small Financial Show. That's where we go through all of this data, try to make sense out of it for all of you. And as I said, it's a lot of information to take in, and we're going to try and get through a lot of the information today. So let's take a look what we have on the show for you this afternoon. We have inflation data and rising interest rates. As I mentioned, Bank of Canada just raised interest rates another quarter point. I want to talk a bit about the effects of these interest rate hikes on investors, on the average person walking around the streets of Toronto or Ontario or Canada in general. What are higher interest rates, or how are higher interest rates affecting individuals, investors, and individuals in general? We're going to have our this week's segment once again, when I talk about what I believe is important for individual investors to consider before you make your investment decisions over the next couple of weeks. What is the risk-reward analysis? It's something that I do quite often, and you know what? I don't even realize I'm doing it. What are the risks versus the rewards that a person could take away before they make that investment decision? And how does it affect the investment decision that they make? Are bonds or money market or short-term investments still good today? I'm asked all the time, Allan, should we be buying more bonds today? We know the market has done well the first half of the year, but are we being set up for a bit of a disappointment in the second half? Should we put more money to work maybe in the bond market, leave some money on the sidelines? You can make a pretty high interest rate on money sitting in money market or short-term investments. So we're going to talk about that as well. Oil prices, they seem to be range bound despite all the production cuts that we're hearing. Well, actually, over the last few days, we've seen oil prices spike a little bit above $70, now above $75. I'm going to touch a bit upon why I think that's happening and the causes and what that means perhaps for inflation going forward down the road. And then we're going to talk a bit about this never-ending idea or discussion about a recession. You know, we've been hearing about recessions coming for many months now. I don't know about all of you, but I'm getting tired of hearing about the recession talk. It seems to be the recession that has never happened. Do I think it's going to happen? Well, we're going to look at some data. We're going to talk a bit about, you know, what is important about if a recession does happen, and why markets fall in general when a recession comes, if it were to come, and when would we ever see a big decline in the markets? What causes a big decline? And lastly, your questions. That's where I like to take all of your questions. If you have any questions during the show, please put them in the chat box. If I don't get to them at the end of the show, I would be love to answer them during the course of the next 2 weeks or out on our next show. So without further ado, let's get on with the show. So as I mentioned earlier this morning, 10 a.m. to be exact, Bank of Canada made their interest rate announcement. They decided to raise another quarter point. Not a big surprise. Many of us were expecting them to raise. I actually thought that it would be kind of difficult just for them to raise once without raising again. You know, they paused for a few months earlier this year, and to then raise one time last month without perhaps raising a second time, I thought was a little bit far-fetched. I figured that they would definitely raise a second time, and they indicated to us that they would do just that. They also indicated at their press conference when the Tiff Macklem spoke during his press conference that if need be, he could see the Bank of Canada raising rates once again. And I take issue with this. I really do. And I said it earlier this morning. I was fortunate enough to be on CP24 talking a bit about the interest rates and interest rates rising. I think central banks are kind of taking this approach that they're going to continue to raise rates until something breaks. Now, for me, I think a lot has broken, especially in the US. We saw 3 bank failures in the US. We know that there are a lot of banks perhaps teetering on some issues in the US, some of them obviously regional banks or smaller banks, but we definitely started to see some cracks in the armor. We're also starting to see some cracks in the armor here. I'm hearing more and more from individual investors telling me how it's more difficult to make their mortgage payments. I know a lot of you that have a mortgage have already received letters from your banks saying that the payments that you make every month have to go up because the payments that you were making no longer cover the interest alone. Back when you first took out your mortgage, you would make payments that would cover the interest plus principal. Well, now for many people, what you're paying is just covering the interest. And recently, that interest payment has gone beyond or above what you're paying. And so many of us have had to increase our mortgage payments. So we're definitely starting to see the cracks in the armor. And the Bank of Canada and Federal Reserve, for that matter, as I say often on this show and my radio show, that happens every couple of weeks on News Talk Radio, is that these central banks want demand to slow. And how are they going to get demand to slow? By using a blunt instrument, and that would be raising interest rates. They would love to see the unemployment rate tick a little bit higher. That would mean people will have less money in their pocket to be able to spend on goods, which, as we know, can drive up the prices and increase inflation. So I sit here and I think, well, the central banks have a dual mandate, that is full employment and price stability. Right now, it just seems like the Bank of Canada is focusing on the price stability, the inflation part. They're okay with perhaps a slightly higher unemployment rate. They've said that. The Federal Reserve has said that they wouldn't mind seeing an unemployment rate tick higher to above 4%. Right now, they sit at around 3.7. So why are they just focusing on one part of the mandate and not the other? I understand that what they're hearing is that people just can't afford these higher prices. We know that hotel prices have gone up 14% year over year. Food prices have gone up 9% year over year. But I say, well, that's very difficult, and I understand that. But if people lose their jobs, it doesn't matter how much prices come down, they won't be able to afford it anyways. So why would you want, or why would the central banks want unemployment to rise so that demand can fall, so that people can now afford cheaper pricing? If you lose your job, it won't matter what the pricing is. You won't be able to afford it anyways. So I disagree with that idea or notion that we need to see a higher unemployment rate to get the inflation rate down. Look what we've done so far. We've brought down the inflation rate in Canada from 8% to 3.4%. In the US, they went from over 9% to a reading of 3% they announced this morning. And employment has stayed strong. But all I keep hearing is that the market is too strong, the economy is too strong, and therefore we need to raise interest rates. Well, last I checked, you don't raise interest rates just because an economy is strong. And in fact, I believe a strong economy is a good thing. I think we all do. I think job creation is a good thing. Having people spending money, retail sales numbers going higher is a good thing. And over time, we will see inflation continue to fall closer to the central bank's mandate of 2%. But I leave you with this. Is 2%, should that really be the inflation rate? I think a 3% inflation rate with people having jobs, I think is just fine. And I think if we can get there, I think that's where central banks should sort of say, okay, we're in that 2.5%, 3% rate level. And I think we need to just take a longer term approach and maybe have some patience. Have patience as we continue to see inflation fall. Now, I have a few charts that I wanted to show about inflation and inflation rates around the world. The first one we can show is up to date now. We just updated it before we came on the air. And it shows all the countries or areas, many areas in the world. And you will see here where Canada ranks, 3.4% inflation, US down to 3%. We can see Brazil just under 4%, which I think would surprise people, surprise me. You go over to Asia, you see places like Turkey, 40% inflation, which is outrageous. Even China, is showing very little inflation right now. So we're definitely seeing inflation fall all over the world, obviously, except for a few countries where inflation remains stubbornly high. But overall, inflation is coming down. The next chart I will show is a chart about the G7, right? These are the Western countries, G7. You can see all the countries to the right: UK, Italy, Germany, France, US, Canada, and Japan. And you can see where we rank in terms of inflation based on the other G7 countries. And you can see we are one of the best with respect to inflation, yet we continue to raise interest rates, and aggressively. I just don't get it. And then I guess our last chart that we have regarding inflation and interest rates is the Bank of Canada rate hikes chart. You can see here with the most recent increase of 25 basis points, you can see that we're now up to a 5% rate. So the Bank of Canada rate is now 5%. Inflation is only 3.4. So you're looking at a Bank of Canada rate almost 50% higher than the inflation rate, the headline inflation rate. And the core rate is somewhere around 4.4% after you strip out energy. So overall, I get it. I understand Bank of Canada is looking at the core inflation rate, but the headline rate is now 3.4. We're going to get inflation data towards the end of this month. If we see a 2 handle on that, I think it's going to be very difficult for the Bank of Canada to continue to raise interest rates while we see the headline number coming down below 3%, the core inflation rate coming down perhaps below 4%. And I just think it's going to be difficult for them to continue to raise rates. So as investors, my main message is today, hang in there. I think rates, or these rate increases, will subside. I think we're much closer to the end. I know Tiff Macklin said today that we're definitely closer to the end of these rate increases than the beginning, obviously. And I know for everybody out there that is concerned about their mortgages, their lines of credit going up, hang in there. Obviously, times are a little bit more difficult. Businesses, it's finding a little more difficult to borrow money to grow. People are finding it more difficult to borrow money to buy a house, etc. But as I said, I think we're closer to the end than the beginning. And hopefully, these central banks will focus on the positive and the fact that inflation has come down so much already. And if they just have some patience, they'll see their 2 to 3% target reached in the not so distant future. So now's the part of the show where I talk about what I believe is important for individual investors to consider over the next couple of weeks before you make your investment decisions. As I mentioned off the top of the show, I think the first thing you want to consider is obviously the quarterly earnings that are coming out. And we'll show the 3 topics that I have for you today. And as you can see, quarterly earnings is the number one. We're going to get a number of quarterly earnings from different companies starting tomorrow with Pepsi, Delta Airlines, although we do already know that Delta is going to report a pretty good number. A lot of people are traveling again, as we all know. We're going to get some of the largest banks in the United States begin to report earnings on Friday, JP Morgan, Citibank, and we really want to look to see what these companies have to say. Second point I want individual investors to consider or focus on over the next couple of weeks is the continual talk from the Federal Reserve governors. What's the Fed speak? What are they saying? What is the macro data telling us, or telling them more importantly, about where interest rates will go from here? Many people believe that they will raise interest rates towards the end of this month, but we all think that September's meeting, because they're not meeting in August, is live, meaning it could go either way. I don't think we're going to see a rate decrease, but maybe we see a pause. So I think it's important to take a look at what Federal Reserve governors are saying. And third, or lastly, contrarian investing. Be a contrarian. I think over the next couple of months, there's going to be a good opportunity to be a contrarian investor and get in on some investment opportunities on the cheap. So contrarian investing, I think, is something you should be considering before you make your investment decisions. So let's talk about the first one. As I mentioned, quarterly earnings. I have a chart here right off the top from JP Morgan. You can see JP Morgan is up on the year from their chart. They kick off earnings season. And I think even more important than them being really the number one name that we look to start the earnings season is what they're going to say, obviously, what condition or where do they see the economy at this point? As we always say, banks are the most important thing to an economy, bloodline for all economies. So when an economy is slowing, the banks are going to feel it. Have things started to pick up for the banks? Have things started to pick up for JP Morgan? We also have a chart here for Citigroup. And you can see once again, unlike JP Morgan, Citigroup really hasn't had much of a gain this year. It's been kind of wavering in the mid 40s for most of this year. So even though the market has done quite well, S&P 500 is up quite a bit this year. Banks in general haven't fared as well. And Citibank is one of those banks that has not fared as well. But what are the banks going to say? Has the IPO market picked up? Have the capital markets picked up? Trading, wealth management, what's going on? We know that lending, that business is probably slowed. People borrowing money to buy big ticket items, businesses borrowing money, small businesses borrowing money to grow is probably slowed down. And we also know that the regulators in the United States have now told the banks that you need to keep a little bit more money on reserve. So we know that there's a bit of a credit situation there. Credit is sort of drying up a little bit. Banks aren't as quick to lend. So what are we going to hear as we get into earnings season, as the banks start to tell us what's happening? And obviously, as we move through the banks, we'll get into the regional banks. What's the status of the regional banks? There's been some talk recently from Janet Yellen that she wouldn't be surprised to see some smaller banks merge together, something we haven't heard in quite some time. So where do we stand, or where do they stand with that? We just heard as early as this morning here in Canada, for example, that Laurentian Bank has put themselves up for sale. So there you go. And that's, again, not something we've heard. Banks buying out other banks doesn't happen too often in the United States or here in our country as well. So earnings, quarterly earnings, very important for individual investors to consider. The second topic that I mentioned on the onset there, when I mentioned all three that individual investors should consider before you make your investment decisions, is this whole notion about what the Fed is saying. What are the federal governors saying? Are they bullish? Do they think that the economy is still too hot? All I keep hearing from Fed governors is that they all seem to be aligned in thinking that they need to raise rates maybe at least 2 more times this year, maybe in July and maybe another time before the end of the year. You don't seem to have any descendants. You don't seem to have people at the Fed, those that have the voting capabilities to decide, well, I'm not in agreement with the general consensus. So everyone seems to be on the same page. And we heard from Austin Goolsbee recently, the Chicago Fed, and at the Chicago Fed, and he is actually talking about maybe we are on the right track. Maybe the Federal Reserve is navigating and can get the U.S. economy to have a soft landing and still bring down the inflation rate. So maybe Austin Goolsbee will be the first Fed governor to break ranks, to move away from what the others are saying. We'll have to see. But every time that we hear a Fed speak, the Fed speak or Federal Reserve governors speak, it seems to be talking about how they're still not anywhere close to the 2% inflation rate. Once again, I'm not so sure that should be the rate. Maybe one closer to 3% is more realistic. But what are they going to do? How much are they going to raise rates? How much are they going to damage the economy, to perhaps damage the economy? Manufacturing has been hit. Obviously, real estate, commercial real estate, lots of things going on in the economy right now. As interest rates rise, this takes its toll on spending, on the growth of the economy. So for now, economy remains resilient, and I guess gives the Federal Reserve the wiggle room to continue to raise rates. So we need to keep an eye or an ear on what the Fed is going to say going forward. And I have one chart here on U.S. Consumer Price Index, just showing you once again that the current rate is now 3% as of this morning, and the core rate is now down to 4.8. First time we've seen it down below 5%. And I actually have one more chart here, and we've seen this chart many times, and it's the chart of all the different interest rate hikes we've seen. And as you can see, June is not there because they were on pause. We think they're going to go. I think they announced a rate decision, I think around the 26th of this month. And we actually fully anticipate that they will raise another quarter point, again, because the economy is so strong. Third and last point I wanted to touch on before individual investors make their decisions as to what they should be in, what they should be buying, is this whole idea of being a contrarian investor again. I think over the coming months, we're actually going to get a few data points. I think we're going to hear from some Federal Reserve governors talking about interest rates going higher. I think there's a seasonality component to what we're going to see over the next couple of months. August, historically, is a softer month, a weaker month. September, I believe, is the worst month for the market for the 12-month calendar year. So we're entering into a seasonal downturn. We're going to hear from the Fed if they talk about raising rates or still raising rates, still some ways to go yet. I think this could give us an opportunity if the market were to sell off based on what the Fed says, seasonal factors, higher interest rates, higher inflation, whatever it may be, it could give us an opportunity to buy some good quality investments that perhaps have gotten away from us a little. Maybe they'll now come back to the mean or back down, so now we can afford them. And again, when you're a contrarian investor, you're looking for things that are struggling right now because you believe down the road they're going to be in a better place and have obviously a higher price. And I've included some charts on some ideas, contrarian in nature, some contrarian ideas. The first one is U.S. Bancorp. Now, some of you may not be familiar with U.S. Bancorp. You can see the chart here. They are one of the largest regional banks in the United States. They call them a super regional bank. And basically, you can see here how their stock has fared. They actually pay a pretty good dividend, 5-6% dividend. So definitely would get paid a nice dividend while you wait. Another name that would be in the contrarian, camp is Target Corp. A lot of you may be familiar with Target. It used to be up here in Canada, now just a U.S. retailer. And you can see how far the price of Target has fallen. They were well over, they were over $200 at one point. Now in the 130 range, a name I think will have good earnings this earnings season. And I think for those that are looking to buy a name on the cheap, perhaps you look at a name like Target. Last name I have here, a chart of, is Walt Disney. Many of you will know Disney. I'm sure many of you have gone to Disney World. Disney used to be about $180 stock once upon a time, not too long ago, maybe a year and a half, 2 years ago, as you can see here on the chart. And today, you're looking at $89. Actually, this chart is, I think, is just showing that it's recent high, but I can tell you, going back a few years, it was definitely even higher than what the chart is showing. Now down by about half. Opportunity. They have new management, new CEO, or I shouldn't say new, but Bob Iger has come back to take the reins at Disney once again. He left and now has been asked to come back and right the ship at Disney. So another contrarian name, a name that I think you could take a look at. Again, may not show the growth you want initially, but I think over time, as we start to see things improve, markets improve, I think names like Target, names like Disney, I think names like USB, names like PNC Financial, some of the banks, some other regionals, I think these names can be a good idea if you were to take a contrarian approach. And keep in mind, over the next couple of months, I think it's going to be a bit of a bumpy ride. But I think that's when, if you have some cash, some dry powder, as we say, you could look to these names and even others to make a good buy on a contrarian type of an approach for your portfolio for the future. So what is risk reward analysis? Simply put, as the words imply, it's the risk you're willing to take for the reward you possibly could have. And I hear all the time people going on TV, the media, talking about, well, the risk reward today is not lining up for me. And I heard recently someone talk about the market in general, right? Especially the US market, the S&P 500, talking about how the markets have done so well that getting into the market, if you're not in already, the risk is a little bit too high because you would be entering at a high point. Well, in my opinion, it is high, obviously 15% or so higher from when we started the year. But I think this is going to be a low point or a lower point than what we're going to see down the road. So I think by the end of the year, we will be even higher. So the risk reward has to be analyzed. You could also do risk reward versus an individual stock. Buying a stock today, what are the risks? What are the downside risks versus the upside potential? I know that when I get into a name like Bank of America, and we have a chart on Bank of America right now, we can show it. It shows how bad or how poorly Bank of America has done. And when I look at the name, again, this name was once upon a time $50 a share, in and around 50. Today trades under 30. You're looking at a 40% decline from the highs of the last few years. So what are the downside risks? I would say downside risks are probably minimal, and that it's only a matter of time before we see the upside on a name like Bank of America. Bank of America has been getting into or has had a little bit of negative commentary around it based on their loan portfolio. Similar to the regional banks, Bank of America also has some long-term debts, long-term loans, long-term bonds on their books. And as we know, as interest rates has gone up so much, the value or pricing of these long-term bonds has gone down. So if you were to market these bonds to today's market, you would see that their prices are down. And if the banks needed, or Bank of America needed to sell these bonds, they would take a loss. So we've been hearing that Bank of America has a lot of these bonds on their books, and that's why they've been having more difficulty than a name like JP Morgan has. But make no mistake about it, Bank of America is a massive bank, second largest in the United States. I believe it is only a matter of time before we see this bank rebound. It also pays a decent dividend in that 2.5%, 3% range. So you get paid a little bit while you wait. But risk versus reward, I think that's something everybody needs to do before you make an investment, before you buy a bond, before you buy a stock, GIC. Some people will say, wow, what's the risk reward on a GIC? Well, the reward is you get a decent interest rate of, let's say, 5%, 4.5%, 5% today. But that's the reward. But what's the risk? Well, the risk is your money's tied up for the next year or two, or however long you tied up, or whatever you purchased the term of that GIC for. So that could be a risk, because if the market takes off, maybe a 5% rate of return doesn't look so good if the rest of the market is making 15, 20%. So there's always risk versus reward. And I think it's very important for individual investors to consider it before you make your investment decisions. And Bank of America, in my opinion, stacks up or lines up pretty good in terms of the risk of owning it today versus the reward you could have going forward. So are bonds a good investment for individual investors to consider today? Well, that's a question, again, I get quite often. And the way I answer that very simply is, it depends on all of you watching. Do bonds make sense? Are you okay with a 4 to 5% rate of return? On some short-term bonds, as I'll show you just shortly, in the US, for example, you're making even more than 5% on a short-term bond instrument or money market instrument, treasury instrument. So are bonds right for you? Well, again, it depends. Are you looking for medium risk, conservative growth, 7 to 10%? Then bonds may not make sense. If you're looking for the portfolio to increase by 7, 8, 9, 10% a year, then maybe you could buy bonds for a portion of your portfolio. If you have bonds paying you 5%, or GICs paying you 5%, and stocks, equities, mutual funds in general, equities paying you 10, 12%, well, 50-50 split, you're probably making somewhere in the vicinity of, let's say, 7 to 8%. Is that a good rate of return? Especially considering 50% of your money would be in a low risk type of investment, or 50% of your portfolio is in low risk and 50% of your portfolio is in medium risk. So stock market reaction and volatility will only affect half of your portfolio. So some people actually like that. They like the idea of having a mix of bonds and stocks, or bonds and mutual funds, or GICs and stocks, etc. So is the bond market right for you? Again, it's all going to come down to what you're looking for, what you want your money to do for you, what your investments should do for you. And I have a chart here we can show United States rates on bonds. Actually, I have two charts, but the first one here, you can clearly see the rates on yields. The 3-month rate is actually 5.3%. You can look at the 6-month rate here, 5.5%. So these are 3-month, 6-month rates. And you can see that they're greater than the 10-year rate, which is only 3.99 or 4%. So you can see how things are a little bit wonky right now. Short-term maturities are paying more than longer-term maturities. And I have a second chart here, which will show exactly that. We always like to look at what we call the 10 and 2-year Treasury spread. And that's the difference between what the 2-year bond rate is and the 10-year bond rate is. And you can see here clearly that it's inverted. It's upside down. And you can see recently it's gotten a little bit better as the 2 years come down and the 10 years gone up a little bit. But when you have a 2-year at 5% and a 10-year at 4%, that's a little bit weird. And if that's what you're thinking, you're 100% correct. And I say it's weird, but that unfortunately usually indicates to us that a recession is coming at some point. Now, I will tell you, as you can see by this chart, we've had an inverted yield curve for quite some time, and we have not seen a recession as yet. When the recession comes, well, we'll get into that in a little bit on the show. But overall, we haven't seen a recession. So hopefully we can see the bond curve or the yield curve start to flatten out and then go back to the way it's supposed to be, where the 10-year or the 5-year is paying more than a 2-year or a 1-year investment or a 6-month investment. That would be a more traditional or normal yield curve. What we're seeing now is definitely not normal or traditional as we're used to. So going forward, are bonds right for you? Well, that's a question to ask your investment advisor and ask them, see what they say. They'll provide you with some guidance, but really it'll always come down to the investor. What types of returns you're looking for, and what do you want your money to do for you? Oil prices. We've talked about oil many times on the show, and for the most part, they've been range bound in and around $70 a barrel. And even though we've seen the Saudis cut their oil production, we've heard that the Russians have cut their oil production by 500,000 barrels per day. The Saudis 1 million barrels per day, and those cuts are going to be kept heading into August. And that didn't even move the oil market or the price per barrel of oil. So what does move oil prices? Well, I think we're starting to see what moves oil prices right now. WTI now is above $75. It's taken a bit of a jump. And why is that? China. We're now hearing that China is starting to import more and more oil. We're starting to hear that the growth story in China is getting better. We're starting to see more and more Chinese traveling around the world once again, spending money. This, in my opinion, is an indication that their economy is getting back on solid footing. For quite a while there, Chinese economy was in a bit of a lull. They were growing, but not at the rates we're used to seeing. And that has helped, most definitely, keep the price of oil down because China, as we know, is the largest importer of oil in the world. So if China is importing less oil, that means there's less oil in the world. Importing less oil, that means there's more oil in the world to go around to all the other nations, all the other countries. But when China is pulling in, 15 million barrels or whatever it is per day of oil, that is a sign that things are rebounding in China. And that is a sign that price of oil is going to start to tick higher. And many believe that we will see oil in that $85 range in the not so distant future. What does that mean for perhaps inflation, the Fed, and interest rates? Well, if we do see oil tick higher, it is a bit of a lagging, it will have a bit of a lagging effect, but I think you could see inflation tick higher. What does that mean for interest rates? Well, if the Fed is just looking purely at the rate, the headline rate, maybe they talk about raising interest rates once again. Maybe the Bank of Canada continues to raise interest rates because inflation is driven a lot by energy costs and oil. So overall, we have a picture or a graph, I should say, of the price of oil. You can see how much the price of oil has fallen. But as you can see here, bottom right-hand corner, it is now ticked higher. And I can tell you today, price of oil is above $75 per barrel WTI. So that's the US measurement for the price per barrel. Brent, which is Europe pricing is well above that as well. So keep an eye on oil prices. Keep an eye on what China says. I believe it's going to go a long way in terms of how inflation might react. It's going to go a long way as to what we can do to mitigate or keep prices of oil down. And one of the ways, and probably the biggest way or the reason why price of oil is down, is our second chart here, is oil production out of the United States. And we see here, the United States produces almost 13 million barrels per day of oil. By far and away, the biggest producer. The Saudis now, I think, are under 10 million. The Russians now, I think, are less than that as well. So the United States, most dominant player in terms of oil production. And the main reason, in my opinion, why oil has remained in around $70. But now, if the United States cannot or can't really increase much more, maybe they can get to 13, 14 million. And if the Chinese and Chinese economy starts to roar again, and the Asian economy starts to roar, we could see oil prices, as many people predict, above 80, maybe 85, 87, in that range. So let's keep an eye on oil. Let's keep an eye on the Chinese economy. And obviously, we'll have to keep an eye on inflation to see if there's an effect that oil will have going forward on inflation. So the never-ending recession discussion, right? We hear about it all the time. Well, we're going to go into a recession. We're going to have a recession. Is it going to be mild? Is it going to be sharp? Is it going to be long? Is it going to be deep? Today, the Bank of Canada actually just pushed out their prediction for recession. At the start of this year, many people thought we'd be in a recession by June. Now, some people are saying maybe end of the year. Now we're starting to hear 2024. We're also, the Bank of Canada is pushing out their prediction into 2025 before we see a 2% inflation rate. So everything's being pushed out. And so those that have been calling on or calling for a recession, they've just been wrong. And I think they kind of save face by saying, oh, well, it's coming. It's just the economy is a lot more resilient than we thought globally, North American economy, the Canadian economy, US economy. And so we will have our recession, but it's just going to be pushed out more. So obviously, many people fear the R word, as we call it. If there is a recession, what are the effects on the stock market? Well, obviously, stock market goes down because we know the stock market is a reflection of the economy. If we have a recession, which is negative growth, that means the economy is not growing, and in fact, has negative growth. So a lot of people believe that we could see the stock market fall, especially considering how high it's gone in the first half of this year. And if we have a decent second half, perhaps that sets us up for a fall in 2024. So my comment about this recession and a big fall in the markets is this. The markets fall for certain reasons. They come down for certain reasons. And usually, or pretty much all the time, I should say, those reasons are reasons that catch us off guard. In 2022, we saw the Fed raise rates last year multiple times, catching us off guard. We didn't realize, even the Fed didn't realize that they would raise rates that many times. So the market had to react to that. And how did they react? By selling off. In 2020, no one could predict what was going to happen. COVID washed up onto our shores, the pandemic. And what happened? We weren't expecting it. Market sold off. 2008, financial crisis. Some people knew what was going on, as evidence from the movie The Big Short, but many people didn't realize what was going on at the major banks in the United States, selling mortgages to people that couldn't afford them, packaging those mortgages and selling them all over the world, creating what we now call the financial crisis. Obviously catching us off guard big time, and we saw the market sell off by half back in 2008. So these are all events that caught us off guard to spur on a sell-off in the markets. Well, I can tell you, the recession call that we're hearing right now has been the most predicted call I've ever heard or have ever seen. So the market is well prepared for a recession if one were to come. And in my opinion, because we're so prepared, every time we see a bit of a sell-off, it seems to be very orderly, and individual investors come in and buy the dip. Why? Because it's so orderly. It's predicted. And in my opinion, a lot of this recession talk is already built into the markets. We saw the markets down big time last year. We saw the NASDAQ down 30%, the S&P down 20+%, the Toronto Stock Exchange down 8 to 10%. We saw the markets down. So I think a lot of that is already factored in. And it would take something out of left field, something we didn't expect, to take down this market significantly. So all this talk about when is the recession coming, when is it coming, I'm going to tell you, you know what? Yes, we don't want a recession, but if it were to happen officially, so we do see 2 negative quarters of GDP, I think we can handle it. I think the market is resilient. It shows how often and how many times it climbs that wall of worry. We'll be able to handle a recession if one were to officially happen. For many, it's already happened. In my opinion, I think we've seen recession in certain sectors at a time, and that makes sense to me. So going forward, don't be afraid of the R word as much. I don't want to talk about recession, but if it happens, I think we will be prepared. So there's a part of the show that I like most where I can address a couple of questions. I know our show has been a little long today, so I probably have time to take maybe 1 or 2 questions here that I've received. First one is a good one. Do I need to be more aggressive in my current conservative portfolio to keep up with inflation? The talk is all about inflation these days. What should my target growth percentage be to keep up with inflation over the long run? I think just in general, when you have low investments paying now 5% or in and around 5%, when those investments used to pay 1-2%, I think your expectation should be to expect a medium or moderate risk return of about, let's say, 10 to 12%. I think a 10 to 12% rate of return makes sense, especially if you can make 5% on a low risk investment. So yes, I think you should look for a slightly higher rate of return, which is what that question is asking. And it's hard to say to keep up with inflation. If inflation is running at around 4% right now, obviously you need to make at least 4% to keep up with inflation. If you're investing outside of a registered plan, outside of an RSP or RIF, then you need to make a little bit more because there's obviously some taxes on that as well. So I think a conservative medium risk rate of return of maybe 8 to 10, 8 to 12, I think that is where you should be fixed on at this time if you're looking at medium risk investments. I'll take one more quickly here. What investment benchmarks do you use to compare rates of return? For me, that's a bit of a tough one. I think the benchmarks or the index or the indices are all very different. I think if you go to the NASDAQ, obviously that's 30% tech. NASDAQ is mostly tech. The S&P is 30% technology. So that's a difficult one to compare your portfolio to unless you have a lot of tech in your portfolio. Toronto Stock Exchange dominated by bank stocks, gold, and oil. So unless you have a lot of that in your portfolio, tough to compare. So I really don't think there's this great index to compare your portfolio to. I think what you want to do, more importantly, is to compare it to your goals. Are you meeting your goals? Are you where you want to be with respect to your retirement plan or your financial plan? And if you are, that to me is more important. So with that, I want to say thank you for joining our show this week. We are back on the air 2 weeks from today on Wednesday, July the 26th. We'll have our show. And I want to also mention that on Sunday, July 23rd, I have a special guest on the Sunday Money Show. Premier Doug Ford will be with me answering my questions on the economy, on business, and we're going to take some excerpts from that interview and play it on the Allan Small Financial Show on the 26th. So great interview. I'm looking forward to it. Premier Ford will be on our show answering difficult questions on growth, the economy, and what's happening in our province. So with that, I want to say again, thank you for everyone for tuning in today, and happy investing.